A sound retirement plan isn't about trying to time the stock market or chasing the latest hot stock tip. It's a comprehensive financial plan that includes tax reduction strategies, estate planning, maximizing your Social Security benefits, and how to safely turn your retirement savings into an income-producing workhorse. Make way for Gerry Benjamin and Woody Alpern, two CPAs located right here in Atlanta with over 55 years of combined investing, tax, and retirement planning experience. Welcome to the CPA Wealth Advisors radio show.
It's the good life, full of fun, seems to be.
It's Woody here on another version of the CPA Wealth Advisors radio show. And yet again, I'm here by myself. Well, not by myself. I'm here without Gerry, but I am here with Al, thankfully. Gerry's on a little bit of an extended vacation, well-deserved. As I mentioned last week, I had just taken my vacation in Indonesia. I was diving for like 7 days straight. 45 dives. I mentioned last week that I'm actually a PADI dive instructor as well. Believe it or not, my passion and love has been diving for a long time, as well as retirement planning. Al, I see you chiming in. What's up?
Well, a man that loves the water and taxes.
Exactly. Isn't that what? Can you believe it? They're both like opposites, would you say? But listen, I do love both. And last week's show was really important. I hope you heard it. I hope you heard my discussion on how the government put in and snuck in these critical Social Security claiming strategies that they put to an end. Really important show. If you did not hear it, I encourage you to go to our website and listen to that one at CPA4wealth.com. And that's the number 4. That's CPA, the number 4, the word wealth.com. We keep our archived shows on our site there. Really important. But this week, I'm going to ask you a question. Do you have an IRA? And do you know how or where your money is invested in this critical retirement account? Let me ask you another question. When's the last time you updated these investments? Let me ask you another question. A lot of questions. How will you withdraw your money from your IRA in order to avoid thousands in taxes, penalties, and fees? Listen, if you're like most Americans, just admit it. Your IRA makes up a big chunk of your retirement savings. But here's the problem. Your IRA is being ignored. It's being ignored. You sink money into your IRA every year, and that's great, but you haven't given any thought to your investments or how these investments work with your overall retirement game plan. An IRA can be a tremendous vehicle to save for retirement, but it's really easy to make a number of mistakes, and these mistakes can cost you dearly. Are you about to make a big mistake with your IRA that could cost you thousands? On today's show, I'm going to reveal how to avoid 12 of the most common IRA mistakes, and then I'm going to share some specific strategies that are going to help you make the very most out of this critical retirement account. So by all means, don't you go anywhere. Listen to how I'm going to help you avoid these 12 mistakes right here on the CPA Wealth Advisors radio show. I will be right back.
Time to get your financial act together. Now you can get a free customized retirement analysis with CPA Wealth Advisors. Discover proven strategies to generate more income in retirement. Learn how to maximize your Social Security benefits and minimize your taxes. And now back to Gerry and Woody on the CPA Wealth Advisors show.
It's the good life, to be free and explore.
Welcome back, everybody. It's Woody here on the CPA Wealth Advisors radio show. I'm alone again this weekend in the studio, but I do have Al, very comforting, and it's a really important show. I really hope that you'll listen to the entire show again, because I got a lot of very important, common IRA mistakes that I want you to avoid. 12, in fact, and I'm really going to try to get through them all. Listen, if you're like most Americans, you don't want to miss this because your IRA makes up a huge chunk of your retirement savings. But you know that there's more to your IRA than meets the eye. Are you better off converting your traditional IRA to a Roth IRA? Is there a strategy to avoid what can be thousands in taxes, penalties, and fees? Have you given any thought to your investments inside your IRA or how these investments work with your overall retirement game plan? One simple mistake here, it could cost you thousands, really, if not tens of thousands of dollars. So coming up now, I'm going to start revealing 12 of the most common IRA mistakes to make. And I'm also going to reveal some specific strategies that I know are going to help you make the very most out of this very important retirement account, your IRA. Let's get started. Number one, write it down. Number one critical mistake, Al, assume you can't have an IRA because of your employer's plan. Listen, a lot of people assume that because they have a retirement plan or work, they can't have an IRA as well. But in most cases, this just isn't true. Because up to certain income limits, you can have both an employer-sponsored retirement plan and an IRA. And that can provide you with a tremendous advantage, particularly in the years leading up to retirement. It's going to give you the benefit of both tax-deductible contributions and tax deferral of the investment earnings. Really important. You can make a tax-deductible IRA contribution even if you participate in an employer-sponsored retirement plan, up to certain income limitations. What are they? For 2015, your contribution will begin to phase out at $98,000, and it'll completely disappear at $118,000 if you're married and filed joint. So you still may be able to do that. And if you can make the contribution, you should. Number two, not making a contribution because your IRA contribution isn't tax deductible. I'm over the income limitation, Woody. Why should I make a non-deductible contribution? Ha 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 ha. You should. Many reasons why. And let me tell you what those reasons are. Even if your income exceeds the IRS limits to make tax-deductible IRA contributions, you can still make contributions. They just won't be deductible. Now, a lot of people, I said, may not be interested in making this because it's not tax-deductible. But that's a huge mistake because even if the contribution isn't tax-deductible, the investment earnings in your IRA will still be tax-deferred. Let's look at an example. Let's say you have $11,000. That's the maximum IRA contribution a married couple can make in 2015, and you have a choice between putting it into an IRA account or a regular taxable account. Either way, you plan to have the money invested in index funds, and let's say you make an average of 10% return for the foreseeable future. If you put the money into IRA accounts, it won't be reduced by your marginal income tax rates, and you're going to get the full benefit of the 10% annual return. That could be worth, if you project it out, about $192,000. But if you were to take that same amount of money and subject it to taxes each and every year, because it's in a regular account, not a non-deductible account, that same amount, it's going to be worth $73,000. Moral of the story, you'll be $120,000 better off by putting your money into a non-deductible account. One more benefit. You may be able to do a backdoor Roth IRA through a non-deductible IRA account and completely circumvent the Roth contribution rules, even if you're over those limits. I'm going to tell you more about that one in a bit. But I want to tell you about our IRA analysis. Since I'm talking about IRA and the 12 common mistakes to make, it's really important because I think maybe if you're like most Americans, your IRA makes up a big chunk of your retirement savings. But there's more to your IRA than meets the eye, much more. Like, should you convert it to a Roth and how you withdraw your money in order to avoid thousands in taxes, penalties, and fees. And one simple mistake with your IRA could cost you dearly. So discover how to make the very most of your IRA with our customized IRA analysis. Yep, this one's brand new as well. just redesigned. We've helped hundreds of people already in this city over the years with our master retirement plan. Now we're focusing on this because we really understand the ins and outs of IRAs. Come and see me to get your customized IRA analysis. I encourage you to call me now to schedule your appointment because these are going to fill up for the balance of the year. And remember, it's quick. It's not going to cost you a dime, and it could ultimately mean thousands of dollars in additional retirement income. So do not wait. 770-622-9145. 770-622-9145. Remember, putting money into an IRA is easy, but getting your money out isn't. And if you're not careful, you could be facing thousands in taxes, penalties, and fees, possibly more. Coming up next, I'll continue to reveal how to avoid more IRA mistakes that could cost you thousands. Keep it right here on the CPA Wealth Advisors radio show.
Do you know how much money you'll need to retire? Do you know how you'll generate any income with interest rates next to 0%? And do you know for certain that you'll never run out of money in retirement? Get a free customized retirement income analysis with the CPA Wealth Advisors. And now back to Gerry and Woody on the CPA Wealth Advisors show.
It's the good life to be free.
Hello, everyone. Woody here in the studio today, just with our producer, Al. No Gerry again on a well-deserved break. But I am talking about IRAs, and I hope you've been listening to the entire show. Listen, do you have an IRA? Is it a traditional IRA or a Roth IRA? Do you know that you could save thousands of dollars in taxes in retirement simply by converting to a Roth IRA? Coming up in this segment, I'm going to reveal the advantages and disadvantages of a Roth IRA. And I'm going to talk about if a Roth IRA may be right for you. And more importantly, how to avoid more common IRA mistakes that could possibly cost you thousands. Hopefully by the end of the show, I will have discussed all 12 of the common IRA mistakes that now I hope you absolutely avoid. Number 3 of those mistakes to avoid is not maximizing your contributions. Listen, many of you have come in and seen me and you said, Woody, I cannot afford to maximize my 401k plan contributions or my IRA contributions. And I said, I'm listening. And our senior most CPA Wealth Advisors listening. And we let you tell us that a couple of times. And then we turn to you and we ask you one simple question. It usually blows you away. And that question is this. We say to you, hey, Bob, let's say your name is Bob. We heard you loud and clear. You can't maximize your contributions, right? That's what you said to us. And the wife's sitting there as well. Yeah, we can't afford it. Don't have any more money. And we say, yeah, but you're sitting on $150,000 in cash, right? You just showed me. You're really conservative, and you got this big cash account right there. You're like, and they say, yeah, okay, so. I said, but why don't you now take the entire remainder of your paycheck from your employee and put all of that into the 401k plan, all of it? And they're like, well, then that paycheck would be zero. We say, yeah. Then just withdraw that same amount of money out of the checking account that you're sitting on with $150,000 in cash. And you just effectively converted that cash right into that 401k plan. It's a no-brainer. And then we prove to you, you don't need that much cash. It's crazy to have that much cash. And then they say, but we maybe need it for an emergency. And we say, yeah, but you also forgot you have an equity line on your home. You could draw on that at the new rates of 2% if an emergency occurred. So you really got to look at your entire picture before you tell yourself or us that you can't maximize your benefits. I mean, the maximum IRA contribution in 2015 is $5,500 or $6,500 if you're age 50 or older. And for sure, you got to maximize your 401k benefits at least up to the employer match. Listen, those dollars are going to stay invested and grow tax deferred all the way until retirement. Mistake number 4, not taking advantage of the spousal IRA for a non-working spouse. This is one of the very biggest and most common mistakes that people make regarding their IRAs. And here's the mistake. They say, look, I work, I make plenty of money, but my spouse doesn't work. So I, as the bread earner, I can put in my $5,500, but my spouse can't because they have no earned income. Nope. There's a huge exception for non-working spouses. It's referred to as the spousal IRA, and it entitles a non-working spouse to make contributions to an IRA virtually the same rules as the working spouse, as long as the working spouse is earning a sufficient amount of income to cover both contributions. So if you're a working spouse and you make $11,000, that means you both can put $5,500 away a year. Take advantage of the spousal IRA for the non-working spouse. Now, I got more rules, but all of this can be analyzed for you for free with our IRA analysis. And I've said, if you're like most Americans, your IRA certainly makes up a big chunk of your retirement savings. But you can see there's a lot more to your IRA than meets the eye. I've been talking about these Roth conversion rules. I said I was going to cover that in this segment. I didn't, but I will in the next segment. That's the next thing I'm going to be talking about. Should you be taking advantage of the Roth IRA? And how are you going to withdraw money, and in what order, to avoid paying thousands in taxes, penalties, and fees? One simple mistake with your IRA could cost you dearly. So why not discover how to make the very most of your IRA with our free customized IRA analysis? We really understand the ins and outs of this stuff. Get your customized IRA analysis before year end. Our appointments are really filling up. Between this week and last week's show on these critical Social Security changes, you need to jump on this. I encourage you to call me right now to schedule your appointment. And that appointment is going to be quick. It won't cost you a dime. And it can ultimately mean thousands of dollars in additional retirement income. Why would you wait? Why would you not take advantage of this by calling me right now at 770-622-9145? 770-622-9145. Are you ignoring the investments inside your IRA? Do you even know what those investments are or how these investments work with your overall retirement game plan? Call me so we can put it all together for you in a beautiful plan that we'll deliver to you for free. 770-622-9145. And when I get back, now I promise, I will cover the Roth IRA rules, the backdoor Roth, and whether or not you should convert to a Roth. So please keep it right here with me on the CPA Wealth Advisors radio show. So privileged to have you listening right here on News Radio 106.7. I will be right back.
How do you safely generate any income in retirements with interest rates next to 0%? $500,000 in a one-year CD will only generate about $400 a month, and that's before taxes. Discover proven and successful strategies to generate more income in retirement. Call the CPA Wealth Advisors for a retirement income analysis. And now back to Gerry and Woody on the CPA Wealth Advisors show.
It's the good life to be free and explore.
I'm back. It's Woody here on the CPA Wealth Advisors radio show. I hope you've been listening to the entire show because I've been discussing 12 common IRA mistakes that could cost you thousands. And now I'm on mistake number 5. And it's all about Roths. And this is a big mistake, and that is not taking advantage of the Roth IRA. Listen, if you've been listening, then this is going to sound familiar. Because once again, we get back to that not wanting to make a contribution excuse because it isn't tax deductible. Listen, in all but 2 major respects, Roth IRAs are just like traditional IRAs. And one is that Roth IRA contributions are not tax deductible. But that brings us right to the second major departure from traditional IRAs. And this is the biggie. And that's that the withdrawals taken from a Roth IRA are tax-free forever. You never pay taxes on that. That is huge, huge advantage. Huge advantage. And guess what else? Roth IRAs are not subject to the required minimum distribution rules. Huge. Huge, huge, huge. And guess what else? It's deemed that your contributions to a Roth, in the need that you have to take them out before you're age 59 and a half, they consider that you actually take out first the money that you put in. So there's no tax penalty if in an emergency you needed to take the money out of the Roth before you're age 59 and a half, as long as you don't tap into the earnings portion. Oh my gosh, that's huge as well. Are you kidding me? This is the greatest gift we've ever gotten. And listen, the fact that there's no required minimum distributions, that means you can allow your Roth to grow until you're ready to begin taking the money out of it. It's a game changer. It's the best thing we've ever gotten. And the income limitations to make a Roth IRA contribution are different from traditional IRAs. They're much higher. If you're married for 2015, you can make a Roth contribution as long as your income doesn't exceed $183,000. And then it'll completely disappear if you're $193,000. Now, let's say you are over that income limitation. You may say, Woody, I can't make a Roth IRA contribution. I make too much money. And I say, really? Have you been listening to my show? I remind you of the old backdoor Roth contribution where we circumvent this rule. And I tell you, hey, go ahead and make a non-deductible IRA contribution. Remember I told you that non-IRA contribution would come back and it's going to be another huge benefit with it? Here it is. Because guess what? When you make that non-deductible IRA contribution and the only other money you have put away for retirement is in your company's 401k plans, you have no other IRA accounts, you can then immediately convert that non-deductible IRA contribution right into a Roth. And because it was non-deductible money, there is no income to recognize on that conversion, and it goes into your Roth tax-free, which means effectively you just circumvented this rule, which is the income limitation rule. No brainer. And by the way, when you are at or near retirement, in fact, once you're in retirement, and then the government starts requiring you to take out your required minimum distributions from your regular IRA accounts, and then you're hit with taxes on that, I may tell you, because you're a client of ours, and we've been doing an analysis and updating it every single year, I want you to take out more than your required minimum distributions, because I'm going to keep you right at the 10% tax bracket threshold. And guess what? I'm going to convert the rest of that into a Roth, the excess over and above your required minimum distributions that you don't need to live on, right to the point where you don't exceed the 10% bracket, because I'm going to have run the numbers for you with our CPA Wealth Advisors. And if we make a mistake, you can convert it back to an IRA up until April 15th. Listen, this is a tremendous planning opportunity. You got to take advantage of it. Now, one more biggie mistake I want you to avoid. Not taking the required minimum distributions or taking the wrong amount is bad. Don't miss it. Guess what the tax penalty is? You may have to pay 50% excise tax on the amount not distributed as required. Ouch. Ouch, ouch, ouch. 50%. So you got to know the rules, how much to take, when to take them when the required minimum distribution rules kick in. Well, with all of this said, that's why I'm talking about our IRA analysis this week, because it's complicated. And if you are like most Americans, then your IRAs are going to make up a big chunk of your retirement savings. And you can see there's a lot more to your IRA than meets the eye. Like, should you convert to a Roth? And how do you withdraw your money? And in what order? To avoid paying these taxes, penalties, and fees. And one of these mistakes with your IRA could cost you dearly. So why not discover how to make the very most of your IRA account with our customized IRA analysis? Why not? It's quick. It doesn't cost you a dime. It can ultimately mean thousands of dollars in additional retirement income. And you're going to wait and not call me now? Why not test me and see if I do what I say? And I've told you that we were the number one ranked in Georgia CPA Wealth Advisors firm by CNBC. Number one ranked. Got to be a reason. Why don't you come in and see if we're for real and how genuine we are? And I promise when you meet our most CPA Wealth Advisor, the founder of our firm, he's going to blow you away. We're going to save you money in every single meeting. I've never had one where that doesn't happen. So how do you do this? How do you test me for free? By calling me at 770-622-9145. 770-622-9145. Because putting your money into an IRA is easy, but getting your money out, that ain't easy. It's complicated, and I don't want you to make one of these mistakes. I'm going to help you avoid it with our IRA analysis for free. 770-622-9145. More of the 12 common IRA mistakes to avoid when I come back in just a minute, right here on News Radio 106.7.
Do you know how much money you'll need to retire? Do you know how you'll generate any income with interest rates next to 0%? And do you know for certain that you'll never run out of money in retirement? Get a free customized retirement income analysis with the CPA Wealth Advisors. And now back to Gerry and Woody on the CPA Wealth Advisors show.
It's the good life to be free. And
Welcome back,
explore
everybody.
the
It's Woody
unknown.
here on the CPA Wealth Advisors radio show. And if I haven't done it already, thank you so much for listening to us each and every week. Really, you actually make my weekend. I so look forward to doing these shows. And I really, truly, sincerely hope that I'm able to convey really relevant and important information that you're taking advantage of. Whether it's you're coming to see me, and of course I want you to come and meet us. I would love you to become a client. But even if you don't, I hope that you've taken this information and gone and seen your advisor. And maybe this has made you think of something that they haven't thought of, or you're seeing another advisor. But yeah, I'd rather you see me. I'd rather you come and meet the number one CPA Wealth Advisors in Georgia. Yes, I want to earn your trust in business. Of course I do. But I still want to convey information to you that's meaningful. And I hope I do that. I really try hard to do that. So with that said, let's talk about the seventh IRA mistake to avoid, because that's been the theme of our show. 12 common IRA mistakes that can cost you thousands. Hope you heard them, because now I'm on number 7. Number 7 is, I hope that you never pay unnecessary penalties on early distributions. There's a host of ways to avoid paying the IRS the 10% penalty on early distributions. A host of ways, but I can't focus on them all, Al, in this show. So I'm going to focus on one method, and that is called a series of substantially equal payments. And this is a distribution method in which your IRA distributions are made as part of a series of substantially equal periodic payments over your life expectancy, or alternatively, the life expectancies of you and your designated beneficiaries. It's a rule that's often missed. Even if you're younger than 59 and a half, would you believe that these rules will allow you to withdraw from your IRA accounts and avoid completely the 10% early withdrawal rule? So if you find yourself in need of money, and you say, gosh, I can't tap my IRA accounts. We don't want you to, but if you just have to create some additional income, if you follow these rules, you'll avoid the 10% penalty. Now, the IRS allows you to set up this way of withdrawing your money early using one of 3 different methods. No way am I going to bore you on this show with those 3 methods. They're crazy complicated. I'll just tell you what they are. And then if you come and see me and you need to do this, I'll implement the right one. One is called the required minimum distribution method. That just means you're going to take this money over your life expectancy. The other is a fixed amortization method where you're amortizing it over a specific number of years. And the other final one is a fixed annuitization method. Aren't you glad just by hearing the names of those that I'm not going to give you the details of what those are? It's just you need to know that these things exist and you can avoid these rules, the 10% penalty. Number 8, do not make this mistake. I've seen it happen. It's horrible. Placing an IRA in a trust. No, never. Don't do it. Don't put an IRA in a trust. If you do before you're 59 and a half, it's going to be taxable when you put it into a trust, and there's also a 10% penalty. Also, on your death, your spouse then cannot roll over your IRA into their own IRA account, which is one of the huge loopholes, right? Because upon your death, once the trust assumes ownership of the IRA, the owner's spouse loses the ability to roll that IRA over to his own IRA without tax consequences. Oh man, don't make that mistake at all. Okay, been talking about all these mistakes, been talking about IRAs, so I created an IRA analysis. That's our giveaway this week. And most Americans, the IRA simply makes up the largest chunk of their retirement accounts. We know that for a fact. And there's way more to your IRA accounts than meets the eye. I've already talked about should you convert to a Roth. We got to do that analysis. And how are you going to withdraw your money? In what order? From what accounts? In order to avoid unnecessary taxes, penalties, and fees, we have to do that analysis. And we know that making one of these mistakes with your IRA, that's going to cost you dearly. We need to incorporate that into your plan. And why not make the very most of your IRA with our customized IRA analysis? Why wouldn't you do this? Now, I'm telling you that our appointments are filling up pretty quickly for the balance of the year between last week's show on our Social Security analysis, and we'll do that for you also this week. And it's really critical because of these crazy changes the government snuck in on Social Security and these avoiding 12 mistakes on your IRA. You better jump on this. I want you to. It's quick. Doesn't cost you a dime. And I know mathematically it can mean thousands of dollars in additional retirement income. Do not wait. 770-622-9145. 770-622-9145. That's it. Colleen picks up the phone. Can't get a nicer person than Colleen. Colleen, I hope you're listening. You are the best. And then she's going to get you scheduled to make an appointment to see me and our senior-most CPA Wealth Advisors, the #1 ranked CPA Wealth Advisor firm in Georgia. #1. That means nobody's ranked higher by CNBC. Please come and see me. I really enjoy meeting you in person. 770-622-9145. That's how you do it. And you get our free IRA analysis and new free Social Security analysis. And when I get back, I'm going to cover the remainder of these 12 critical mistakes to avoid. Don't go anywhere. Keep it right here on the CPA Wealth Advisors radio show.
The last thing you want to be is 75 years old, full of life and flat broke. Put 55 years of tax, investment, and retirement experience on your side. You're listening to Gerry and Woody on the CPA Wealth Advisors show.
It's the good life to be free and explore.
It's Woody back on the CPA Wealth Advisors radio show. Final segment here. Really important show today. Hope you've been listening to it all because I've been talking about the 12 common IRA mistakes that could cost you thousands. And I am now on mistake number 9 that I want you to avoid. Listen, number 9 is missing some important dates on inherited IRAs. I don't want you to miss these dates. Here's the dates. There's a deadline that applies to beneficiaries who wish to disclaim IRA assets that they inherit. By September 30th of the year following the year of the owner's death, the beneficiary whose life expectancy will control the payout period must be identified. So generally, IRA beneficiaries who want to receive distributions over a life expectancy must begin taking those required distributions by December 31st of that same year. If you inherit an IRA, you're going to have to be prepared to move quickly here. Come in and see us. Let us help you with that one. Number 10, not taking advantage of the IRD as a beneficiary. What is the IRD? This is missed all the time. An IRD is income in respect of a descendant. So the IRD designation allows beneficiaries to take a federal income tax deduction for any estate taxes paid on IRA assets, thus limiting double taxation of the IRA assets. Really important. So if your IRA had been included in your estate and you happen to have a huge estate that caused you to pay estate taxes, you better take advantage of this IRD deduction on your federal income taxes. Really important, and it's missed a lot. Number 11, not naming or updating IRA beneficiaries. Okay, listen closely here. Not listing primary and contingent beneficiaries may result in the distribution of the IRA assets to the IRA owner's estate, resulting in accelerated distribution and taxation. Terrible. Not keeping beneficiary designations current and coordinating them with other estate tax plan documents, guess what? That's going to lead to conflicts and unintended results. And one major advantage is an ex-spouse. Yep, your ex-spouse, the one that you no longer can't even think about, may end up inheriting a retirement account of yours if his or her name is still listed on the actual plan. People often mistakenly believe that your divorce decree that specifically excluded an ex-spouse is going to solve that problem. It won't. You must specifically remove your ex-spouse as a beneficiary, or that person is going to inherit your plan. Also, most IRAs list the owner's spouse automatically as the primary beneficiaries. Oh man, you don't want to miss that one. You do not want to miss that one. Also, by designating a specific beneficiary, remember, that allows those, if you're already in your required minimum distribution period when you pass away, that allows the beneficiaries to take those remaining required minimum distributions over their longer life expectancy rather than your remaining shorter life expectancy, or worse, over an accelerated 5-year period. Don't make that mistake. Make sure you update your actual plan documents or your IRA beneficiary designation forms. Number 12, the final mistake to avoid. Do not roll low-cost basis company stocks. You missed rolling low-cost basis company stocks into an IRA. Big, giant mistake. Okay, let me explain it. This is called the net unrealized appreciation rules. Remember that distributions from a qualified plan, right, such as 401ks, those are generally taxed as ordinary income. But if you have company stock in that plan rolled into an IRA, then future distributions that come out of that, they're going to be taxed as ordinary income. But if instead you take the company stock as a lump sum distribution right now from the qualified plan, you are only the cost basis of that stock is going to be taxed to you as ordinary income. This is called the net unrealized appreciation rule. Key here is that the distribution must be taken as stock, not cash. Now, the remaining appreciation, which is the difference between what you paid for that company stock and its current fair market value, is not going to be taxed until the stock is sold, and it's now outside of the IRA account. So it would be taxed as long-term capital gains, which potentially are taxed at a much lower tax rate, especially if you're now in retirement. Heck, you may not pay any tax on that at all. Incredibly important that you don't roll low cost basis company stock into an IRA from a qualified plan. Instead, you take it as a distribution. You take the actual stock right out of the plan, don't roll it into an IRA, pay the tax on the cost basis, and preserve the capital gains for way later at a much lower tax rate. I hope you listened to this show carefully. If you did, then you're certainly going to want to take advantage of what we're giving away this week is our IRA analysis. And if you listened to the show last week, you know that the government put an end to critical Social Security claiming strategy. So you're also going to want our brand new revised Social Security analysis. So our IRA analysis and our Social Security analysis work hand in hand. And it's really important because IRAs make up a huge chunk of your retirement savings. So discover how to make the very most of your IRA with this customized IRA analysis. And as I said, we'll also do the revised Social Security analysis. This stuff is quick. It's not going to cost you a dime. And it will ultimately mean thousands of dollars in additional retirement income. I want to meet you, and I want to prove it to you that we really do what we say. So don't wait. Call me now, 770-622-9145. 770-622-9145 to give me really the privilege and honor of meeting you in person and helping you with this stuff, because it really is a privilege and honor to us. 770-622-9145. Gerry and I both will be back next week, Saturday and Sunday at 10 a.m., right here on News Radio 106.7. I hope you benefited from this show. Thank you so much for listening.